Just a reminder, the last crisis was a financial crisis. And the first thing that had to get worked out was the banks and the banking system. And the Fed, I would say, very much had first chair in the last crisis. This is a health crisis. So the Fed is doing, and I'll talk about it in a second, everything we can do to support. But I would say at best, we're a third chair here, a highly active third chair, but a third chair nonetheless. So what are the first two chairs? And then I'll talk about the Fed. The first chair, of course, is health and public health. That is the most critical. Someone wrote an editorial a month or so ago that said the single best stimulus would be nationwide testing. And I very much ascribe to that. Testing, social distancing, making sure the hospitals have enough capacity, importantly and critically coming up with vaccines or treatments or protocols. All of those are the first chair here. And it's very hard to get the economy back to where we want until we can tell people they can get their health, they can feel comfortable about their health. So that's really the first lane. The second lane, as Susan said, is fiscal. And I very much think of the recent packages we've put down, that the government has put down, as fiscal stabilization, not stimulus. I was a Boy Scout. It's very hard to light damp kindling. And until people are comfortable shopping or traveling or eating out, you can throw as much money into stimulus as you want, but you're not going to get the reaction you're hoping for. I do think, though, these are really critical elements of stabilization. Unemployment insurance, so the tens of millions of people who are going to be unemployed have some payments to low and moderate income individuals. The small business loan program, which has just gone live last Friday. Funding to endangered industries, both specifically like airlines, but also more broadly, a Main Street lending facility I'll talk about in a second. These are all good concepts, but critically, and I think quite challengingly, we need to get them delivered. And so just to give you some examples, you may have seen this notion of sending out $1,200 checks to every individual. You might think that's really easy. Roughly half of the economy, by the way, probably the higher income half, files electronically. The Treasury Department has their routing numbers, and it'll take until mid-April for that money to go get electronically deposited. The other half, you have to send them a check. And there's not a giant printing press out there ready to go write a bunch of checks. There's not a bunch of addresses that are current. A lot of people in this population actually move a couple times a year. And so the Treasury's got real challenges trying to get that money in the hands of people. You saw it very similarly on the small business side. The Small Business Administration probably didn't have any experience trying to get cash in people's hands a week after legislation. And they launched last Friday. My understanding is that website's been absolutely overwhelmed with hundreds of thousands of applications of people in need. And I think they said on Friday they were able to fund 3,000 or 4,000 of them. So there's just real challenges in getting the apparatus of our institutions to deliver money to bridge people and small businesses at sort of the scale and scope that you need them to. So those are the first two lanes, health and fiscal. I should talk about monetary and the Fed's lane. Given our independence, given our history in 2009, we were ready for action and frankly able to move the fastest. Three things we've done. The first is we moved rates down to zero, which is as low as we can move them. We did that upfront and in advance. Not confused about whether this would create some massive stimulus, but I think trying to set the terms of policy in the right level so that when we come back, we're ready for movement there. I would say there is value in places like mortgages where you're continuing to see refis and originations in that space just with money as cheap as it is. Second thing we're trying to do is to encourage the banks to step up. And we do have a different situation than we had 10 years ago. We have a very healthy banking system. We want those banks to continue to do the right things for their customers and not to hunker down and scale back in a time of real need. So we've given supervisory guidance to encourage them to show forbearance to good credits in need and to give reassurance that we wouldn't be criticizing them next month for good things they're doing this month. We've taken on a couple of the ratios that may have been constraints to this kind of behavior. We've changed some of the capital ratios for some of the smaller community banks to encourage them to lend. Our banks remain very liquid, and we're doing what we can to make sure that they're motivated and incented to do the right thing at this very difficult time. The third thing, and the thing that's probably gotten the most press, is intervention to try to make markets work. We've been in a situation where the equity markets have plunged. A lot of usually very liquid and critical markets like the treasury market and the mortgage-backed market have ceased up. And so we've been in force trying to intervene in those markets to make sure that spreads go down to normal levels so that lending rates for consumers and small businesses are at appropriate levels. In addition, we have, with the collaboration with Treasury, set up a number of backstop facilities for commercial paper, for money market funds, for primary dealers, for some asset-backed security markets. Those backup facilities, backstop facilities, are intended to make sure that those markets continue to function as well. You had a week about 2 weeks ago where even investment-grade corporates were having trouble rolling over their debt. And so we're just trying to make sure that folks who deserve and who ought to get credit are able to get credit. The new legislation actually creates a partnership between Treasury and the Fed, funded by about $430 billion, to try to set up some additional facilities. These facilities have not been announced and set up yet for the most part. There's a corporate facility for both new loans and for secondary market loans, and then something called a Main Street lending facility. We're in the process of trying to figure that out. Legislatively, that's got to be a partnership between Treasury and the Fed. It's got to be agreed to by both Treasury and the Fed. And we have some challenges. Think about it this way. The Fed isn't actually allowed to lose money. We're not allowed to make credit allocation decisions. That's the role of the fiscal authorities, Treasury. Treasury's got some interest in having that $430 billion get repaid, at least based on what they've said. So how much credit risk to take in these funding facilities versus where to direct them to get the most benefit to the people most in need, that's a real challenge. Neither Treasury nor the Fed has a credit underwriting function. The banks do have credit underwriting function. So how much do you leverage the banks to do the credit underwriting for this? But also, how do you make sure that you're not either incenting the banks to make bad loans, or you're not transferring too much value to those people using the distribution system? That's another challenge. And then how do you get the money out there quickly, as we've seen in the small business program, is a challenge as well. So those are all coming in the next couple of weeks, but very much in the process of being worked on. One thing that was announced yesterday is we did say we would fund for the small business program. We would allow banks who had made those loans to set those loans onto our balance sheet, and we would fund that. That just creates more capacity for them in the picture. Anyway, hopefully you get a sense. We're using the authorities we do have under the constraints given to us legislatively to try to backstop a number of these funding markets. But again, I would put that as third chair behind health policy, which is the first chair, and fiscal, which is the second. I might just close and turn to what I think the core challenge is. How do we get to the other side of this with a healthy population and a functioning economy? That obviously requires the shortest possible duration of this shutdown, which is consistent with good health. But I think there are three other keys that I might just spend a second on. The first, and I don't think this is talked about enough, is we need our essential industries to continue to operate. We need food manufactured, we need packages delivered, we need fire and safety, cleaning supplies, cash processed in our essential operation, hospitals functioning, supply chains operating, inspectors inspecting, electricity on, broadband available. And we have a huge swath of our economy where workers are going to work every day now, with pride that they're an essential business, but also with concern about whether they can stay healthy. And I think it's just critically important that we keep these workers healthy and motivated, and these businesses operating. The second thing I think we're going to need is a return to business and consumer confidence. This shutdown has been a real shock to all of us. To get to the other side, we're going to need consumers to spend and businesses to invest again. But that's not as simple as it sounds. Remember, when we flatten the curve, we don't eliminate the infection. We actually flatten the infection. And so people will still be contagious on the other side of this. Now, maybe a treatment or a vaccine will occur. Perhaps all the fiscal and monetary stimulus that we've put in place will kick in once the crisis is passed. But I actually think we're going to need a jolt to get ourselves investing and spending again.
Okay, point number 3 is we're going to need a health protocol. What China has done is they've brought their operations back. That's doable. But bringing consumers back, I think, needs a whole different level of confidence. You need to know that you can shop or go to a restaurant or travel without putting your family at risk. And I refer back to 9/11, where it was a mess for 3 months. But at the end of that, you knew that the TSA was in place, that we were taking extra precautions on safety, and that it was safe to fly again. And sometime after we deliver a rollout of full testing, and after we hit the downside of the infection curve, each and every business is going to need a story. I think supermarkets are doing a pretty interesting job. You're met at the door with someone with a mask and who's got wipes, who wipes down your cart and sort of sends a signal that we're taking this seriously. If you stand in line, you've got little tape on the floor to show what distance you should stand to have appropriate distancing. And I think every consumer business in this country is going to need to have a set of protocols, whether it includes, temperature testing or sneeze guards or exposure, something that, middle seat empty on a plane, that just sends a message to consumers that it's okay to work and shop. And I think that's what we're going to need to get us back. So I apologize for the disruption at the end. Maybe I'll pause and Gia, turn it back to you for thoughts and questions.
Sure. So I have first question submitted. What do you believe the role of nonprofits will be in the long-term recovery, specifically as it relates to workforce development programming?
Good. Well, it's pretty interesting. The displacement. If you just take the number of workers in food service, in travel and tourism, and in retail, you're well over 30 million, which is 20% of our workforce. If you believe that there's a risk, and I do, that a lot of those businesses are going to come back slowly or at less than what they were, then that's a workforce that needs opportunities and will need reskilling. And that's not your natural infrastructure workforce. In other words, you could do an infrastructure program, but I don't believe many of those people are ready for or interested in construction projects. I think we're going to need to come up with what are the places those people need to go. Maybe it's home health, which are going to be growth industries that we need to put them in. So I think there's a very real role in thinking about what the workforce of tomorrow is. And I wouldn't be surprised at all if it's different than the workforce of yesterday.
Thank you, Tom. What do you expect the impact of the pandemic to be on the housing market, particularly for housing production and affordability? During the recession, housing production slowed. This meant that 10 plus years later, the supply of affordable units doesn't match the growing demand. Will this problem become worse?
Well, so far, the folks I talk to who are in housing construction continue to operate. It's a more open air kind of operation, unless you're in one of the states that has declared that non-essential. A few have, but most are still operating. So I think we will get more construction. I think with mortgage rates this low, we'll get more demand. I guess I should just say the one thing we never do is make the same mistakes twice in a row. And housing was right at the center of the last recession, and because of a lot of dynamics, both purchasing behaviors by younger folks and construction behaviors, as you said, we ended up with this situation with too little supply for the demand. I think, going forward, we have a shot here of building out some supply. I think that's an industry that, fingers crossed, still hasn't been affected as much as some of the others I mentioned. And then I do think the folks who have delayed purchase over time will eventually come into the market. So I'm a little more optimistic on the housing market than you just described.
Thanks, Tom. At some point, this novel coronavirus season will pass. We are seeing the response tactics play out. What will be the essential components of the recovery phase once we are in the clear, once the clear is sounded?
Yeah, I really empathize with the folks in political authority who are going to have to make the call about how to do it. I think it's very hard to just show up and say, all right, it's done, at a time where you've still got infection happening from contagious people. But I would imagine you could say, we will allow people to return to work under these conditions: temperature testing, social distancing, whatever. You know, as I said, in China, they actually are back to work, and the infection rates, as best as we can tell, have not, skyrocketed. And so many of our essential businesses, including ours, are continuing to run. It actually gives me hope you can operate with enough safety and a protocol that your infection rates won't swamp your situation. I do think the bigger situation is, how are you going to convince your family, my family, any of our families to go eat out at a restaurant or take a discretionary trip? I just think that's going to be a lot more, there's going to be a lot more hesitation there. And that's why I say we're going to have to think about how we present ourselves as businesses to convince people to take that extra step. And you can imagine a little step versus a big step. How would you feel about an open air restaurant as opposed to a closed bar, et cetera, et cetera? So I think it'll be tiny steps. In China, the return of retail, even 8 weeks later, based on Shopper Track, is only about 50% of the traffic that they had before. So it'll take a long time.
Thanks, Tom. What market signals do we need to see before confidence is restored for business to resume CapEx/investment programs?
Any CapEx decision, you're looking at future cash flows, you're putting a discount rate on it. The discount rate is highly influenced by uncertainty. I think it's really hard right now to make an investment decision with this much uncertainty. So I think something that creates a little more certainty would be good. I'll also say that huge swaths of this economy are mostly thinking about liquidity right now. If I can't make payroll in 2 or 3 weeks, I'm really not thinking about an investment. So I think that's another big piece of it. I come back to the first lane of this, which is health policy. The place where we will really have, I think, a rebound is where you can look around and tell Americans you can go out and be safe again. That could be a treatment, that could be antibody, that could be vaccine, that could be they've now seen enough people out there who seem to not be affected that they have confidence, whatever that is. And when that happens, I actually am pretty optimistic for the economy and for investment, because I believe at that point, you've got a lot of stimulus, both fiscal and monetary, that is at play. And I think that's when that stimulus comes to roost. Most downturns, if you look at it, have a pretty big bounce on the recovery. I think our challenge is the healthcare concerns are dampening our bounce.
Thanks, Tom. How can credit unions like community banks help in recovery?
Well, I think of credit unions very much like community banks, with very strong knowledge of your customers and clients being the biggest strength and reason you've got credit unions. And what we've got here is a bunch of individuals and businesses who need understanding, and they need to understand. They need someone who knows this isn't a person who's going to default on a loan. This is a person who's been put in a bad situation for 3 months by a health policy that was necessary to maintain hospital capacity. And if you know your customer, then you know that person is the one who needs and deserves the funding. And so I think that this is actually where credit unions, community banks, I think, ought to be able to show their strength, because they do know their customer, and they know the ones who are going to make it through to the other side. And you have, therefore, the ability to support those people at their time of need.
Thank you. Do you have an opinion on what a stimulus for infrastructure would look like and how it could improve the economic outlook?
Um, the legislators are certainly going to be better at stimulus than I am. I would start first and foremost with healthcare. Hospitals, I've talked to several of them, are really struggling right now because um, they've taken all of their higher margin surgeries out, and they're taking on these critical and essential but uh, less remunerative operations. And I think we absolutely need to be supporting the hospital system of this country, probably stronger than it's been supported historically. Getting tests in the hands of each and every one of us, supporting vaccines, distributing ventilators, distributing masks, all that stuff to me is job one of any package. I think the second issue is, what is there then a reasonable bridge to get from where we are to where we're going? And if you believe, as I believe, that the recovery will be slow, I think you're going to find that a lot of the things that have been passed, like the small business loan, which is really a 2-month forgivable loan, all these small businesses are going to wake up in 2 months and say, yeah, but this is going to take 6 more months. So how do you support that group? That's a second piece. I think infrastructure is desperately needed in this country in many different places. And so in general, I'm supportive of decisions to spend on infrastructure. Like I said, I just wouldn't confuse an infrastructure investment plan with necessarily hitting all of the workers who are being displaced. So I want to think hard about those workers who are being displaced and make sure that they're going to benefit from that kind of spending plan.
Thanks, Tom. What's the likelihood that the Treasury, SBA, Congress will provide more funding for the Payment Protection Program, assuming that all $350 billion will quickly be exhausted once the SBA gets through all the initial glitches, technical processing issues, considering it is a new program they seemingly were not ready to go live with this past Friday?
There's a lot of editorial in that question, but I'll just get to if this money does go out to the right kind of people, which is certainly the intent of the SBA and the Treasury who are behind this program, then I do think the demand for it is going to be enormous. And if the program's seen as successful, and if the demand is greater than the supply of funds, I certainly would hope that would be something the legislators would take up. I believe the president actually said something to that effect yesterday.
Thank you. What should states do to help local governments weather this crisis?
Well, I think this is a very challenging issue for local governments. And, if you're a city that depends, like Richmond, where I live, that depends a lot on a restaurant tax, and the restaurants are all closed, that has very real implications. If you're a city that depends on property, or school system depends on property taxes, and property values get diminished, that's a real issue. A lot of states are dependent on income taxes, by the way, being filed 3 months later, so you've got a hold there, and a personal income of folks. So I think most of the municipalities in this country are going to be very, very challenged by this situation, as with any downturn. Many of them have reserves, and that's important, and that's what they're used for and need to be used for. But just like the last downturn, I think there will be a need for support of, let's call it, governments across this country, because if you don't, a lot of them have balanced budget requirements, and so they're going to end up cutting on other services to meet those.
Thank you, Tom. Do you see a lot of office space as telework becomes the norm post-pandemic? Is it possible we see a population migration from urban centers that will further negatively impact merchants negatively?
Let's see. On the office buildings, I think it depends. A lot of the world has already been comfortable with some amount of telework. I certainly had always been. And maybe there'll be parts of the world that are a little more comfortable. But I'm a little more of the view that humans do like affinity and being with other people, and that we may buy a little bit of flexibility because of our experience here. But, in the end, we're all going to be dying to go back to the office and see our friends and colleagues there.
Um, Coming out of the 2008, 2009, a lot of entities decided on creating, let's call it more collaborative work environments, fewer assigned offices, more bullpens, more whatever. I think that'll evolve a bit. I think the notion of collaborative space is probably going to be doubled down, because if people are working 4 days a week in an office and not the other way, maybe you'd share space. On the other hand, maybe you'll have maybe you have sneeze guards between the bullpens. Maybe there'll be a little bit of more distance between people in the office. So like always, I think that'll evolve, but I still think there's a desire for people to work together and benefit to being together. And remind me, your second question was urban rural, I mean.
I'm sorry.
Well, I would say the mega story when it comes to geographic disparity has been that the entire world was moving to the big hot cities, San Francisco, New York, Washington. And I don't think it's coincidence that San Francisco and New York were two of the first places hit hard just because of density. And so it wouldn't stun me at all if there started to be a secondary story where people started moving to places with a little more room and a little less density. But I think that's highly, highly, highly dependent on whether we wake up in 6 months and have a treatment and a vaccine and everyone feels safe. I think if we do, then I don't imagine as much change as we're talking about. But if we don't, I would.
Thanks, Tom. Often mentioned is a liquidity crunch spillover into credit markets. The Fed is addressing this by providing liquidity. What other spillovers are of potential concern?
Well, I think there's always an issue as you provide liquidity, which I'll just call the whack-a-mole issue, which is as certain markets start to feel comfortable, all of a sudden other markets feel uncomfortable. I think institutionally the Fed is much more, well, legislatively we're not allowed to take losses. So we're not in the world of credit allocation. We're able to support liquidity but not make credit. And so as we push into investment grade, I do think that'll have implications on lower rated corporates, for example, especially those not covered by the Main Street facility. If we do, whatever we decide to do on the municipal side, those who are not covered will have liquidity issues when we're not. And so I think that's a natural outcome, but wherever we take a position, I think the places on the next edge are the ones that are going to get hit the hardest.
Thanks, Tom. When will the details for the new Main Street loans for larger businesses be released?
We're working hard on it, is what I can say. As I said, we've got to, again, by statute, land this with Treasury and with the banking system. And I think, as I sort of referenced earlier, there are issues of how far down the credit box should we be going in this? How do we lend money to the right people, not the wrong people? There's a second set of issues on how do we underwrite it? Do we do it? Do the banks do it? Or some combination? There's an issue of who bears the cost and or the upside of these loans that are made as you get in the distribution. And as you may have noticed in the legislation, many of these loans are attached to constraints around things like buybacks or layoffs and the like, and how exactly we define that is hard. And one of the reasons that there was a question earlier about the small business and the challenges they had getting launched, I just think it's really hard to launch a facility in a week. And so it just takes a few weeks for us to lock this down. We did come out with the details on the commercial paper facility this week. That's going live, I think, on the 14th of April. We came out with a PPP offset program, and we're working hard, but these are hard to do.
Thanks, Tom. How can we as individual consumers deploy our discretionary spending to have the most positive impact right now?
That's a good question. I sort of, you'll remember George W. in November of 2001 said, some version of show the terrorists that were okay to shop, and consumer spending was up 7% year over year, I believe, in November of 2001. I do think the U.S. is a consumer economy. Consumer spending is 70% of the economy. And I think those who have the means to spend in the consumer side of the house are as directly as you can imagine keeping people in business.
Thank you. One last question for Tom, and then I have a question for Susan. Tom, what kind of education and training strategies should we consider? Can governments incentivize people staying at home to acquire new skills now? Are you aware of federal or state efforts to leverage this time to address skill gaps and help displace the end of the pandemic?
Well, that's a really interesting question. I'd say in the white collar workforce, where a lot of us are working from home, I have been told that training completion has been escalating as people have time and actually focus on it. But I don't think that's the population you're talking about. I think the population we're talking about is the 30 million service workers who may find that a year from now, being a waiter or a bartender or a retail clerk doesn't have nearly the job prospects that we thought it did a year ago. And I do think it'd be incredibly valuable to be investing in job training programs for those folks. And I have not heard of efforts at scale doing that just yet, but I think that's a very valuable thing.
Thank you, Tom. And Susan, a follow-up question. Which of the scenarios Mackenzie laid out do you expect to be the most likely, and what do you feel are the key steps for trying to nudge us towards the better outcome?
Well, I think that countries are definitely going to end up in different places in that matrix. For the United States, I think we can safely say that our social distancing measures are having some benefit. So we're definitely not in the bottom row of the public health response. And we're clearly also not in the leftmost column in terms of policy response. So the question is, we're probably in the middle row so far on effectiveness of containing the virus. How can we nudge that up to the most effective? And I think just by complying with social distancing, as well as having the FDA approve some of the serological tests, rolling out rapid testing more aggressively is going to help. So I think over the next few weeks, we'll see if we're able to move up to the more rapid containment of the virus. And then I think on the policy side, we're clearly somewhere towards the right side of the matrix. So my hope is that we do get the rebound in consumer spending later in this year that Tom talked about. When we have the health protocols in place to feel safe going out, I would hope that by the fourth quarter, we would have a strong rebound. Now, I talked to many executives across industries across the US, and I have to say that the prevailing sentiment is for a slower recovery from what I hear. Maybe I'm a natural optimist, but I'm hoping that we could get a strong bounce back and put this behind us.
Thank you, Susan. I had another question come in for Tom. Please feel free to use the chat box to add any additional questions. Tom, are there any metrics being analyzed to determine when it's safe? What are we shooting for to consider the eventual return to the new normal? Is it number of new cases, doubling, treatment, ability, global metrics?
Yeah, so obviously the Fed's not doing that. That's being done by the public health officials in the states and at the federal level. But, it's probably, we can learn stuff from what's happened in other countries. I think, first of all, the whole notion of flattening the curve, which is the reason we're doing the social distancing we're doing in the first instance, has to do with hospital capacity. And so I'm told there are a lot of people focusing very hard on the question of, at the expected infection rate, given where we are we going to have enough capacity in our hospitals, enough ventilators, enough and other equipment, but also enough beds so that we can handle what's coming. And so I think that's a critical metric. And I don't think there'll be any relaxation of social distancing until you get comfortable that the healthcare system can handle it. Second thing then is less about the operational capacity and more around, I'll call it, assurances can you give to the population that we're not just going to release everybody and restart it all over again. And I do think that has something to do with the number of new cases and that flattening and starting to head down. I suspect it'll be a judgment call as to where on that curve. We're never going to get infections to zero. And I can't imagine we're going to wait until it's actually zero. But an infection rate such that you don't feel this thing is spreading, but that you feel it's back under control again. Those are the two things that I've heard people talk about. But obviously there are those who are focused on it more than I.
Thanks, Tom. What emerging industries and technologies might see accelerated growth during recovery efforts, especially those that might have been emerging slowly before the crisis?
Well, I don't know about you, but I'd never heard of Zoom until 3 weeks ago, when my daughter was told she was going to take all of her college classes via Zoom. And, you know, all of these, let's call it a distance, commercial distance technologies, I think, are going to have a huge opportunity. Anything that has to do with delivery, anything that has to do with online shopping, but also online transactions. I think there are a lot of retailers, and I'll say this unfortunately, who are going to accelerate their deployment of automated checkout and things like that. You know, anything to lower the risk to their employees and the risk to their customers in this and other pandemic. So I think there'll be a set of things that are around automation and in particular consumer automation that'll probably get more uptake and stronger rollout. As just a start, I'm sure there are lots of others.
Thank you. And do you feel the DMV region will be an economic leader or laggard coming out of this shutdown?
Well, obviously the economy here is distinctively, you know, federal government and contractor driven, and it doesn't look like federal government funding is going down these days. In fact, it's up quite significantly. So I think in the short term, this region is probably somewhat sheltered compared to the situation in many other regions. You know, what happened, and that also was true if you go back to 2009. All that said, you know, when budget discipline becomes a government priority again, you'll tell me when that is. As it was in 2011 and 12, all of a sudden you start to see the cutback, and the numbers for this region actually lagged for a few years after that happened. And so I know that will happen.
Oh, I'm sorry, Tom, you're cutting out.
But sorry, I said I don't know if it'll happen here, but it's certainly conceivable.
Thank you, Tom. One more question. What % of return to December 2019 levels for the Dell, the S&P are expected in the next 3 months, in the next 6 months?
If I knew the answer to that, I'd have a different job.
Any other questions? Okay, what country should we look to that employed the best practices to deal with the pandemic, if any?
I think most everybody would have said 10 days ago, Singapore and Hong Kong. Now, they have models that involve a lot more tracing and tracking of people than we would be otherwise comfortable with. They're now seeing a second cut at it. I think South Korea obviously is another good example. I come back to where I started, which is this is at its core a public health emergency. And I do think, I certainly was surprised 3.5 weeks ago
to learn that we didn't have enough tests to go around. And so, we're fighting an invisible enemy without something that will bring light to the situation. And I really do think if we had access to testing on demand, this would be just a much, much, much more controllable situation. We would have had significantly less dislocation. And if we could roll it out going forward, the same thing. So those like South Korea, Singapore, Hong Kong that have done that kind of testing broadly and focused and then acted upon it, I think that is the way to go here.
Thanks, Tom. We had a few more questions come in. Flattening the curve is because of underinvestment in hospital capacity. The healthcare system doesn't service peak capacity because of IRR requirements of privately owned healthcare. Any implications from this on future IRR for public goods?
I certainly hope we're going to come out of it and ask ourselves the question, what kind of property, plant, and equipment are we going to need? And that includes hospitals, but it includes ventilators, includes masks, it includes beds to service something like this if and when it happens again. By the way, we did that, after 9/11 in many ways too, and often it takes a crisis for us to focus on what we need to do. But I, would imagine that would involve having significantly higher hospital capacity as well as PP&E. What's really behind it from a hospital standpoint is a complicated question. There have been many books written. I liked one Stephen Brill wrote that sort of try to get underneath the economics of the hospital system, but there's a lot of problems in a business model that's driven by significant cross subsidies. And, there's probably a better way to build that mousetrap, but whether we'll get there or not, I think it is beyond my prediction capability.
Thank you, Tom. Our public debt exceeds $22 trillion and US debt to GDP is near 80%. What might those numbers look like when this is over? How concerned are you about our long-term outlook on debt?
Thanks. Very concerned. Before this crisis started, the CBO had projected we'd be in the upper 90s by 2027, and that assumed no recession, and that assumed that certain of the recent legislation would be backed off at some point. We're going to run $1 trillion deficit before this started. I think we're probably headed toward $3 trillion if you just add in the $2 trillion package, and then when you have a recession, your numbers go south as well. So call it $4 trillion. I don't know. So that'll go, well, we're easily, I think, headed over 100%. What's hard about this topic is the old Hemingway quote that you go bankrupt gradually and then suddenly. Japan is about 180% of GDP is their debt. Not that I aspire to be Japan, but you can survive at a higher number. Italy's at 140 or 150. I certainly don't aspire for that. But there will be a moment at some point where investors around the world say, I just don't like the credit risk of this franchise. And when that happens, they're not going to put us into bankruptcy. What'll happen is long-term interest rates will spike, and that will be significantly restrictive for the economy. But that could happen in a year, that could happen in 20 years. It's just very hard to know when that is. But I think we'd have a lot more capacity as a country to do a lot of the stuff we wanted to do if we had a budget situation that was better. All that said, you need government to be spending right now. So I'm not against the notion of the fiscal initiatives we've taken most recently. In fact, I'm very supportive of them because we've taken a health policy answer that has implications for other businesses. This isn't a situation where one set of businesses did something wrong and now, they're asking to be bailed out. This is one where we took a health policy decision. It's got implications for other businesses. We ought to spend as best we can to make the bridge. But then I do think on the back end, we ought to have a business plan that gets our fiscal house in order.
Thanks, Tom. A few additional questions before we close out. Should we be concerned about bank failures despite federal support measures?
At this point, the health of the banking system remains extremely strong. And I've seen, good data and recent data. If anything, their liquidity has gone up, not down, because people have traded out of riskier assets and put their money in cash. So I don't think there's anything at this moment to worry about with the banking system. Obviously, if we have an extended downturn, that will have implication for a number of credits, and that will have implication for banks too. And that's something that we, as the folks who regulate the banks, watch closely. But there's certainly nothing in the near term that worries me. And I think the bankers I'm talking to are working very hard to make sure that they provide credit appropriately, but don't end up, in bad spots. And again, we've done a lot over the last 10 years to improve the health of that system.
Thanks, Tom. We're receiving a few questions about getting back to work. Can you talk a little bit more about that? Do you think there'll be a test and trace put in order? And do you think that the fiscal house will eventually mean higher taxes for everyone?
So I think getting back to work, I start with operations. Again, I think I think that there are protocols that many firms on the call, probably certainly my call, and my firm are operating, that are keeping the operations running while keeping people healthy. They include temperature checks and sending people home who are sick, and wearing gloves and social distancing and masks in some cases. And so I think there are a set of protocols one can use to operate successfully. So I'm actually less worried about that. I think whichever political entity makes the authorization will probably do it gradually, let people back under certain constraints. Maybe stores today are allowed 10 people in a store, maybe they'll go up to 15 or 20, however they decide to do it. Again, I'm more worried about the demand side of the equation, and so I'm less worried about getting people back to work and more about getting people back to shop. On the increased taxation, I think every government entity in this country, from the federal on down, is going to be in a more challenged fiscal situation a year from now than they were 3 months ago. And so then their options are to cut spending, or to increase taxes, or to grow. I don't know that there's a third lever to help finance something. And so I assume you'll see lots of different choices made along that spectrum, but I wouldn't be surprised to see tax rates stabilize or increase in certain places.